who's joining us now in studio for a look at the confusion that reigns around Abil and the whole unsecured lending industry, is Dave Woollam. He's from Summit Financial Partners and, of course, a man with a deep insight into Abil, having been the Chief Financial Officer there some years back. Last time you were here with us, you said when you left Abil, you had misgivings. They seem to have come to fruition.
Thanks, Alec. I think my concerns in this industry have been building for a number of years, and whilst the results in Abil and certainly across this industry have come to a head in the last, say, 6 months, 12 months, I think one needs to go back quite some time to see really what happened.
They've been building. A head of steam has been
This has been
starting.
a head of steam that has been building up for quite some time. And what we're seeing now is, I guess, the final, the final outcomes of that, which have translated into very poor results for these companies. But if one goes back, the start of this industry was built around some fairly simple principles. Unsecured lending is a high-risk business. That's a starting point. Mortgages, one experiences very low default rates, but one always has the security of an asset, so you can keep your interest rates really low, and it's a very tight model, a lot of cost focus.
Unsecured means you don't have an asset.
Unsecured lending is you have no asset, you have no security.
Base it on.
And so what you have to do is rely on the person's ability to generate income and therefore repay you. And if one looks at the start of this industry, there was a kind of benchmark, which was that roughly 15% of consumers who were lent to would default. So 1 in 6 for many, many years. This is going back from almost 2000 all the way through the mid-2000s. And then after recovery processes, when the collections process would be engaged, you would end up with a net loss of about 10%. So roughly 1 in 10. You would lend out 10 loans, 1 borrower would default. The model then worked on the basis that you could price for that 1 default, you could recover your costs, you could pay your funders and earn a nice return for your shareholders. What then happened in the late 2000s, the competitive pressure, the competitive environment has started to build up. And each player started to try and outdo each other. And so they started to lend longer terms, larger amounts of money to consumers who they were perceived to be as low risk. So all the dialogue, all the talk was, we're going to increase our exposure to low risk customers. But the very nature of that was that pushing credit into that low risk space created high risk customers because they took on too much credit. And so what happened is that was
there not a central repository where you could see that Alec Hager's coming in to borrow from Abil, but he's already borrowed from Capitec and he's got this line of credit on the other side with FNB? Is there any way of checking that, or did you just have to take the word of the customers?
No, they're bureaus. The bureaus are very accurate. Creditors could see exactly who had exposure to what. But in many cases, it was the creditor who was wanting to increase their exposure to a customer.
It was the other way around. It wasn't necessarily me coming in and saying, please give me more money. It was the bank saying, don't you need more?
Absolutely. There's no doubt this has been a sales push industry. A lot of marketing, which is natural. And I think if one looks at banks, one has to realize that there are two forces always at play in a bank. There's the sales, lending, trading side, which is wanting to take risk. And then you've got the credit and the risk management people who need to be able to understand, moderate, and reflect on that risk. And there need to be strong people on both sides of that equation who, together with the CEO, will find a harmonious balance.
It looks like at Abil, the marketing team was in the
I think the marketing team had the ascendancy, and I think in the industry that happened, and there was this push. What happened though is there was a kind of sandwich wave almost effect, is that as these bigger loans went into the market, yields started to fall. Bigger loans mean cheaper loans. The assumption was bigger loans to low-risk customers would be lower risk, and therefore you could compensate for those lower yields with lower risk. But there was a long emergence period of when that risk would play out. And we've seen, like in the cell phone industry, lower margins, bigger volumes, you get the trade-off, it's fine. In this industry, what happened is lower margins, the risk started to emerge 12 to 18 months later, and suddenly the bad debts popped. And what we're seeing now is a default rate of 25%. And
not the old 15
not
or
the old
10
15
net.
And what we're seeing is a 25% default rate with a 15 to 20% net. And so when you see that doubling, the pricing that you assumed simply can't absorb it. And then you've still got to pay your costs and you've still got to pay your funders, so shareholders lose out.
But that still doesn't explain why a company like Abil's had to go back to shareholders. It didn't really have visibility, it appears, on how deep the hole was. Keeps going back to shareholders and saying, well, we need a few more billion rand.
I think that, it's hard for me to really understand what the motives of an individual company were. But if I look at the whole industry, it's almost like there was a foot on the accelerator and that foot was stuck on the accelerator. It was very hard for the industry to pull back that lending. So we've only seen really in the last couple of months the likes of Abil and some of the bigger players really pulling back. They've been talking about pulling back, but we've seen brokers analyze the sales data and we've seen there's no doubt that there was still a big push of sales. So
what happens next, Dave?
Well, I think what we're faced with now is a very large number of people who are struggling to repay their debts, and the normal process of filtering those people through a collections process, whether it's to go through the courts to an EAO or garnishee, or whether it's a debt counseling, there simply isn't the capacity to manage those people through the existing infrastructure. And the work I'm doing with Summit and with various other players in the industry is to say that what we really need is now a special solution for a special problem. We need almost a national debt rehabilitation program. We can't solve this. It's got to a pandemic level. And what we need now is all role players. We think employers can play a very important role because the well-being of their employees is critical to their future productivity. If one just looks at this mining crisis,
sure. Yeah.
The issue is not so much that miners are striking, and they are striking for more pay. And people ask and say, well, how have they gone for 10 weeks with no pay? The truth is that many of those miners don't have any pay, because after debt repayments, they don't have any money to take home.
So it's a no-lose situation.
For a lot of them, their take home is a few hundred rand a month, or maybe 1,000 rand a month. So they're actually saying, well, I've got nothing to lose.
But what happens to those who supplied them with the debt in the first place, the debt providers? They clearly aren't able to.
They clearly have the NPLs building up, which is
yeah.
what we're seeing, is this big bubble. And the National Credit Regulator stats show that nearly 50% of all credit consumers are now in default.
So if we talk about the losses that have been incurred in the platinum strike, for instance, and it's the employees have lost billions of rands. At the moment, they're not feeling it. The people who will be feeling it will be the financial institutions or the loan sharks who've been lending to them.
I think so. The order of magnitude is employers have lost productivity, credit providers have lost access to their collections, and the employee is the last one to lose whatever net residual money he was getting. In many cases, that was meager and a pittance.
Well, Dave, it's a crisis, and as